Without further ado, I have the pleasure of introducing our tonight's presenter, Dr. Bardia Hariri, MBA, PhD. He is a licensed financial professional and insurance agent, holding active licenses in California as well as many other states. He leads a team of dedicated advisors with strong administrative support. Dr. Hariri is a strategic thinker focused on helping individuals, communities, and businesses. With over a decade of experience in financial industry, he has a deep understanding of economic principles, community development, and growth strategies. His PhD thesis from University of Wales focused on the emergence of isolated nations into global consumer culture, driven by his passion for Middle Eastern economics, history, and politics. Dr. Hariri excels in identifying opportunities and developing innovative solutions, prioritizing community development and sustainability for long-term success. Welcome, Doctor.
Thank you so much.
Of course.
I appreciate it. Thank you. All right. Very, very good evening. Thank you so much for being here on a Thursday evening to hear more about taxes. I love taxes. I'm not too sure about you, but I really love taxes. Raise up hands. How many of us have filed 2025 yet? Have we filed 2025 taxes yet? Oh, you already filed it. All right. Okay. Wow. Well done. So we want to talk about things that can help you to reduce your 2025 taxes. If you learn something, we can adjust it as well, right? So it's not too late. How many of us, by the show of hand, think that we are paying too much taxes and it's not fair? Can I give you news? Do you think taxes are going up or down? Do you think we have to pay more taxes or less taxes in future? More? How much is our national debt right now?
31 trillion.
34.
34.
34 with 12 zeros. $34 trillion in debt. Somebody has to pay that, right? So most likely we have to pay more taxes. And can I remind you that back in the Second World War, the highest tax bracket was 90%. 90. Back in the 60s, if you talk to your grandparents or parents, back in the 60s, it was about 65%. How much is now? 47%. So we are historically at the lowest tax bracket in the history, and we have the highest debt in the history, $34 trillion. So it's important to know how to plan. How to plan because taxes are not going down. We have to have a plan that reduces our taxes today and tomorrow, right? And that's the main payoff of this lecture, right? So it's a little bit of a last-minute planning for 2025, and then we want to understand how can we be smart for 2026 onwards. I don't want to overwhelm you. We will only look into 10 topics, 10 areas, 10 tips. Feel free to cut me anytime. It's more interactive, right? So before I start the main topic, thank you, Dr. Mariam. We are based in San Francisco. If you have any question, you can always reach out to us. We have presence in 13 states. In California, we have San Francisco, Roseville, and Irvine office. So I think San Francisco is the closest. Feel free to reach out. I will be able to send you the slides after the event. So feel free to read and reach out for any questions. Let's start with some tax saving strategies, which is the easiest part. I hope this file is big enough that we can see. Yeah, absolutely. Take photos. Yeah. We're talking about 2025, right? Now, the very first trick to reduce your taxes is to show less profit, right? How do we show less profit? By creating expenses or deferring our income. this topic that we are going to talk, this particular table shows you how to defer your taxes. And there are different strategies based on the age. This is the age. And this is based on the suitable pockets that you can create based on your company revenue, based on your employee size. For those of us who just started, we have a smaller practice. We can, depending on your age, we can put up to $16,000 into our IRA account, $16,500. If we are over 50, we can put up to $20,000 a year into our simple IRA account. And guess what? You can still put that dollar there and reduce it against 2025 taxes. For those of us who have a small, slightly larger practice, we have more cash flow. We have the 401k and profit sharing, which cumulatively we can dump up to about $70,000 and reduce our gross income. And if we are over 50, I don't know what happened. If we are over 50, we can put up to $77,500. Let me reset it in case. Let's see how it looks. Jim, we might need your mighty hands for that. Okay, perfect. So anything that you see on this table, you still have room to do it. It's not too late, although we are in 2026. Now, there are practices that normally, making more than, $900, $1 million a year, that they say that, hey, I already maxed out my 401k, I need more deductions. I want to have more deferral. That's where we go to the last three options. Depending on your age, for somebody who is in their 50s and 60s, they can put up to $450,000 tomorrow and show $450,000 less profit and do not pay taxes. And if you think about it, every single dollar that you put into these accounts will give you about 47 cents deduction. For $1, you get 47 cents deduction. So we're talking about 47% rate of return on that dollar. And that dollar obviously grows in the market 7, 8, 9, 10%, right? So we're talking about 50, 55% rate of return on your dollar, right? So depending on your age, depending on your goals, depending on your liquidity needs, right? Depending on the company size, these are the options that you can have. That's why a conversation with your CPA or with your financial advisor is very important before you file taxes. So that if your CPA says that you have to pay $80,000 in taxes, okay, let me just put that $70,000 to my SEP IRA last minute. At least I'm going to pay about $30,000, $40,000 less in taxes. And I grow that money and I double it every 7 to 10 years, right? So that's one strategy, right? Any questions up to here? Yes, sir.
So we have 401k for all profit sharing, safe harbor, and cash balance.
Perfect.
So can we still put in like a SAP or 401k?
Very good question. 401k and cash balance, or 401k or 412(e)(3) plan. You can do it together. You cannot do these last three and a SEP. Right? So if you already have 401k and you already added the profit sharing into it and you put 70, 75,000, 77,000, I don't know what I did. You can still put another, if you don't mind me asking, how old are you, roughly?
56.
Okay, perfect. You can still put another $450,000 and reduce it. Yes, sir.
Another question.
Yes, sir.
Long story short, I have a little issue with my content. But, the corporate tax already filed.
Okay.
My personal, that's why I'm going to have a meeting tomorrow. Not very happy. But, so 412 is still enough.
You can adjust it. Yeah, you can still adjust it. You can still file taxes. Just in case, if you don't think that you have the availability of $400,000, you can still do that until October. Very good question. The very first step is to have a census. A census that says who are the employees, what is their age, what is their wage, what's the start date, what's the termination date, how many hours they're having, right? And based on that, we can figure out how much can go to the owner, how much should go to the employees. If we have highly compensated executives who are in their 50s and 60s, That's the time that we have to run the numbers and see whether it makes sense to do it, because we have to do it for them as well. If it doesn't make sense, then we have a backup plan. What's the backup plan? A management company. So many of the dental practices, they have a lot of senior doctors. They want to really put this much for themselves, but then they see, oh my God, there's another doctor that I have to contribute the same amount. I don't want to do that. Then we open up a management company. The management company can be lead generation, can be R&D, research and development, right? Can be marketing department, right? That management company is going to be owned by their adult kids or by their parents or their in-laws or somebody that they trust. The management company is going to hire the doctor and then will charge a corporation $400,000, $600,000 a year. And then through that, we can defer taxes without taking care of employees. Does that make sense? If not, I can explain again. All right, yeah. So there is a way for it, right? Plan A, we figure out that, okay, we can put 90% of the dollar without paying anything to the employees. Plan B, if we have to take care of employees, then we can have a management company so that the management company will be able to transfer more cash so that we don't have to worry about discrimination laws. Yes, please. The management company is the salary that you're deferring. This is a deferral, right? So the management company is going to charge the company A, right? So we have company B, which is the management company A, which is the main company, right? The management company is going to charge, let's say, $600,000 a year, right? The management company pays you as an executive, maybe $100,000 or $180,000, right? And then the remaining of it will be your deferred compensation as a highly compensated executive, like a chief strategy officer, right? Now, if additional cash is needed, then we have to see, do you have adult kids that you want to pay them as well? Then we can put them on the management company, or parents or in-laws. Somebody who is not your spouse and you trust them. Normally adult kids over 12 in one, or parents or in-laws. Siblings as well, but not the husband or wife, right? Questions? So this slide just talks about how much we can defer, depending on how much we are making and how old we are and how many employees we have. And we still have time before we file, even if we are going to file extension, right? And that's one excuse that many CPAs have. We work with a lot of CPAs. Basically, CPAs and attorneys are main power partners. They send us referrals through these programs. And because this takes about 3 to 4 weeks, at least, to set it up, normally clients end up filing extension. So if you think you still want to defer taxes and you want to do a little bit of planning, but many business has ups and downs, you may not have the liquidity, file for extension, so you have the entire of the summertime to build up the liquidity to put it into the relevant pockets to reduce your 2025 taxes. Does that make sense? Questions?
The management company preferred this form. I want to know if they have to pay taxes.
Right. So the management company, let's say, receives $600,000, right? So pays you as a highly compensated executive $160,000, $180,000, right? And then the remaining of it is a deferred compensation, is a deferral account. The management company doesn't pay any taxes because all of it is expense. Expense number one is your W-2. Expense number two is the deferred compensation, right? That's the whole point of management company, right? Plus, you can even add a little bit more so that you can even have some other expenses, which I will explain it in future slides.
So are you saying that we've created another company in addition to the practice that can put away more, have a pension plan for themselves?
Absolutely. Yes. Many practices don't need that unless they have a lot of employees, and then the main owner takes a look into these options and says, hey, I want to take care of myself, but then I don't want to pay a lot to my staff. Then that's a backup for it. Instead of taking care of everybody, You can actually have the management company, which is owned by your kids, by your parents, by your in-laws. The management company hires you as a chief strategy officer, highly compensated executive. You get your W-2 from the management company, and you get to have your deferred compensation.
What's the case I can have this rather than cash balance?
So,
Why do I still have the cash balance?
so if you already have the cash balance plan, which means you already have the $450,000 max, right? Then the question is, do you need more deferrals? Right? Because you already contributed $77,000 into your 401k profit sharing, and you're going to have an additional $452,000, which is good enough. There are 8 other strategies if we still need additional deductions.
So for the cash balance, if he has cash balance, can he still add on the defined benefit plan? Do you have both plans? Or is one or the other?
These 3 are actually defined benefit plans. Depending on the type of investments, they have different names. And because you cannot put more than $4 million in one defined benefit plan, their investments are different. Their rate of returns are different. This is the safest. This doesn't grow more than 4 or 5%. That's why you can put more money into it.
And so you could potentially have like a cash balance plan and then a separate plan that is a defined benefit to put in money in different, like you could max out 4 million here and 4 million here.
Not with the same company.
So you will have to
So if you have already maxed out your defined benefit plan with one company, then we need another company. Absolutely. Yes, 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 sir.
We say having the kids manage it. At what age were you?
21. 21. Yeah.
That's like a hard rule.
Yes, it is IRS rule. Yes, yes, yes. To become the manager, to become the owners of the management company, they need to be 21. But there is still another strategy which you can even hire your 9-year-old and 12-year-old kids. And I will go through that as well. There's another strategy, but they cannot become owners. The management company must be owned by a 21-year-old or more. Yeah.
So next time is actually at one of the years before.
Perfect.
So any issues?
No. Anything that I say is to become a manager. You mean? Okay. Conflict of interest. What does he do? He's auditor.
Yeah.
PwC. UI. Okay. Depends what vertical he's working. Do you know who are his clients?
Usually high tech.
Not from the management company, not from the IRS, there is no problem. Unless his line of work requires him to disclose that, unless his employer has restriction. From IRS, no problem. From the custodian, no problem. From fiduciary standpoint, no problem. From third-party administrator, no problem. Unless his employer has issue, which I doubt, but check with employer. Yeah. So, bottom line, before filing taxes, we can put as low as $1, as high as $450,000 plus $77,000, depending on your age, liquidity need, and your company size, and your overall goals. And still reduce your 2025 taxes. Right? That's the main narrative of this slide. Any question before I go to the second one? Yeah, it's just an S corporation. Yeah, it's just an S corporation that you need to create. You need to make sure that you have somebody that you trust, right? Not a spouse, either siblings, parents, or in-laws, or kids who are over 21.
What is the goal of how much
like I don't think you can say you've made zero. You couldn't.
You can technically,
But does it get
as long as you're within the limits, because you're paying yourself about 20% in W2, 20% of your revenue. Your qualified expenses are another 20%, right? In average, 20 to 30%, right? and then the rest is deferred, right? As long as these ratios are there, you can't pay yourself 60%, right? You can't show 70% expense if this is a mature business, because at the end of the day, your business should have 30-40% profit margin in average, right? So as long as the ratio makes sense from the auditing point of view.
And then is there a point where you have, like, I know we expect when we retire, we're going to make money, but
Very good question. Very good question. Exactly. That's very important, because at the end of the day, you are not getting rid of taxes, you're deferring it. That's why there are 8 other strategies that we have to talk about. This is not getting rid of the taxes, it just defers it to sometime in future. The question is, when you retire, are you going to be at the lower tax bracket or not? Are you going to retire in California or Nevada?
or is it going to be 90%?
Exactly. Exactly. Second World War was 90%, so not that I remember Second World War, but I have read it. Yeah. So deferral is one strategy, right? But then deduction is another strategy. Creating tax-free pockets is another strategy, right? Is a combination, is a hybrid model, right? So strategy Y was maximizing your retirement contribution, which, as I mentioned, as low as $1, as high as $450,000 from defined benefit plus another $77,000 for your SEP. So you can put up to almost $500,000 depending on your age and your liquidity need, and reduce your taxes today. Now, HSA, we all know what it is, right? Health saving plans, right? These are the limits for 2025. So if you do not have HSA, you can still set it up for yourself, right? It's very easy. You can just literally, I can guide you all of this, but you can also do it, just Google HSA. It's very easy. These are the limits. If you have a family, dependents, about $8,300. Individuals, $4,100. If you're over 55, add another $1,000 to above numbers. That's the max that you can set up HSA, and you still show less profit because these are all paid by the business. Any dollar that you put into HSA, you can invest it. It grows tax deferred, right? It grows with S&P 500, the top 500 companies in the US, growing at 8, 9, 10%. It average doubles your money every 7 to 8 years, basically, right? And then later on, when you have some out-of-pocket expenses your insurance doesn't cover, you can use the HSA to pay for it. Later on, you have long-term care needs, HSA will pay for it. Long-term care is very important, by the way, especially women. Women live longer. We just die. Yeah, just die. Yeah. Women live longer. 75% of women in the last 3 years of life go through extended healthcare situation. They need help with the basic activities of daily living. Cognition, mobility, transferring, right? Those ADLs. So it's very important to think about it. And this HSA not only can take care of the home care facility or hire a nurse, but also can pay for the premiums of your long-term care insurance. So it's win-win, right? And long-term care is really important, especially for women. In California, we are talking about almost $50 an hour to hire a nurse. In average, 75% of women in the last 3 years go through it. I do have a client. I love her. She's 97, sharper than me. She's just on a wheelchair. 7 years on long-term care. 7 years. And she's paying about $18,000 a month for 7 years. You can imagine, right? So it's expensive. In California, it's very expensive. So these little things helps. Yes, please. Exactly. Yeah, yeah. So that's another thing. So before you file taxes, make sure you have this. By the way, I can email you the slides. You have any question, you can reach out to me. Yeah. All right. This is where we are talking about our younger kids. So, especially in your field, it is somehow justifiable to hire your 6-year-old and 7-year-old as well, because you can always take a nice picture of them and put them on the social media to promote dental services for kids, right? So now, when I said here hire a spouse, this is very important, because at the end of the day, in California common property, and you're filing jointly, so we have to see how is the tax bracket of your spouse. If your spouse is in the same tax bracket or higher, then there is no point. If your spouse is in the lower tax bracket, sure, it makes sense to hire them. Kids, as long as they're not having a job, still makes sense to hire them. And I will tell you what we can do with that money. Basically, this is the main point. Shifting income to lower tax bracket. Parents, in-laws, if they don't have jobs, if they're at the lower tax bracket, hire them. It's absolutely fine, right? Now, one thing to remember, if you have a, let's say, 9-year-old, 12-year-old, 13-year-old, they are not most likely having any salaries anywhere, right? You can pay them from the business up to $14,000 a year. Business gets the deduction, right? It's a business expense. How much your kid has to pay in taxes? None. Up to $14,000 a year, your child doesn't have to pay any taxes. So if you have 2 kids, multiply by 2. If you have 3 kids, multiply by 3. So business pays, kids receive it tax-free. Now, if you want to be super smart about that money, then we can put that money into either their 529 or their ATMA or the cash value account so that it grows tax deferred, right? Yes, please.
So my daughter is like 17.
Perfect.
Should she not get a job elsewhere then? Because she wants to get some job.
It's okay to pay her, but the moment that she has a job, then when her salary, total annual reported income goes over 14,000, anything over 14, she has to report in and pay the taxes. Yeah, it depends how much she makes. Yeah, exactly. Yeah.
Why not have them pay some taxes at a lower tax bracket?
Sure. Yeah, absolutely. Absolutely. As long as they're at the lower tax bracket. Yeah. They will file on their own. Yes. If it's over 14,000. Yes. After 18, they can file on their own. Now, if they are making over 14, they have to still report it, but through you. It's their salary, right? But through you, you have to report it.
What's the max that's safe to
14 is a little bit more, but keep it within 14. It's actually 19,000, but you didn't hear it from me. Just keep it within 14. Because if you put exactly 19, then you may get, some audit or something. Just keep it around 14 is safer.
If they're students, or
A university students.
Yeah, if they're full-time university students.
Do they have salary?
No, if I'm paying them through the office, are they still eligible for the educational credit?
Are they getting FAFSA, federal aid?
No.
Are they getting a scholarship or?
Yes.
But that's for their academic merits, not for their finances, right? Okay, it doesn't jeopardize their scholarships. No, it's fine. Yeah. If they're on FAFSA, federal aid, then it will mess up with that. Yeah. If you're already claiming from government to pay for their fee, then don't pay them, because then it contradicts the narrative, right? But if they have their own merit basis, academic based scholarship is fine.
You say it's under 14,000 that's federal.
Both. It's fine. Both. Yeah. So, kids, same thing for parents and in-laws, right? Speaking of parents and in-laws, if you have parents or in-laws who are living with you, and if they need some sort of a help, make sure that you have applied for Social Security for them, right? Anybody living, parents living with them? No? Yeah? Okay, perfect. So Social Security has a benefit that as long as you can justify that your parents need some sort of a help, maybe even driving to the grocery store, language barrier, some sort of a help, right? A social worker comes and visits you in your house, takes a look into their situation, and then they can define a benefit for them, which, as long as they're living with you, is tax-free, right? So you can also pay from the business to your parents, right? Now, as long as it's under $14,000, it does not mess up with their government benefits, right? So you can maximize both government benefit. Technically, they pay you to take care of them, and then on top of that, your business pays them, right? So that's something that we can talk more to run numbers for you. Okay, I will explain. So if you have parents who are living with you and they need some sort of a help from you, you can ask the government to reimburse you for taking care of them.
Oh.
Depends how much of a care they need.
I see. So is that the one that's IHSS?
Correct.
Okay, that's my sister's.
Perfect. Perfect. And you still can pay up to $14,000 to your parents from the business, and it does not jeopardize their IHSS. All right? Yes,
It
please.
doesn't jeopardize. Okay, up to 14.
Yes, from the business.
Oh, we have to wait to pay them.
Kids, you mean? You have to justify it. Let's say you have a 2-year-old. Can we justify it? If you get audited, let's say you say, yeah, I'm taking a picture of my 2-year-old, putting it on Instagram to promote services that we offer for kids. Sure. As long as it's justifiable, yes. In dental practice, it's much easier because you can take pictures and say, hey, there are models, right? If you had a construction company, it wasn't possible. Are you using child labor? Yeah. Yes, please.
So, I mean, do you pay them as a W-2?
Yes. You pay them on the W-2. You report it, but because it's up to $14,000, they don't pay any taxes. Yeah, they're basically modeling. Yeah, and depending how old they are, right? I mean, if they can do some office work, sure.
Is there any benefit?
Benefit on paying 1099. We will miss out on one thing. There is something called the tax code is IRC section 162. IRC section 162 is executive bonus plan. You can actually say because you're an executive, you're using it as a bonus. So you're taking more deduction, not just at the corporate level, but also at the personal level. If you want to pay them 1099, it's just an expense, right? So my recommendation is W-2. Yeah. And then many people, they just let the business to pay for the kids, and from that money, you can open up Roth IRA for them. You can open a 529 account for them, which is only for education. You can open up UTMA. UTMA is Unified Transfer to Minors Act. It's like a brokerage account for minors. You can invest in stocks, mutual funds, everything, right? Or you can open up a cash value life insurance for them, which grows tax-free, right? So for kids, you have few options, depending what's the purpose of the money. 529 is only for college. So what if they don't go to college? What if they get a scholarship, right? So the money gets penalized. Basically, you have to pay 10% penalty if you don't use your 529 for education. So think about it, how flexible you want to be. That's 529. Second one was UTMA, Unified Transfer to Minors Act. That's exactly the same brokerage that you have. Investing in mutual funds, ETFs, brokerage account, right? With UTMA, there is a positive and there's a negative. Positive side is you are the custodian, the owner is the kid, but the moment that they are 18, literally on their 18th birthday, you no longer have access to that account. You have to literally call together to, let's say, Schwab or Vanguard, wherever you opened it, and transfer the ownership to your kid. So what if your child is not ready yet? What if your child is not financially responsible yet? So that's the trick that you need to know. That's depending on how financially savvy and responsible is your child. But the good thing about Atma is when they take the money out, they pay taxes at their bracket, not your bracket. Right? So it's case by case. If you have a financially responsible child that you know that by 18 they're okay to take the money, sure, do it. Because then they take it at their bracket, not yours. But if you want to have more control and you want to have it flexible, cash value life insurance is good too. Index universal life. It grows at 8, 9, 10% tax-free. You take the ownership. At any point that you want, you transfer the ownership to them. That's something else that people do as well. Yeah, it's tax-free and it's flexible. And all of that can be paid by the business, and every dollar is tax deductible. Yeah. Any question?
But first pay them, and then you can
Business pays them.
pay, the business
Pays them.
and then transfer the.
Exactly. The payer, exactly.
Cash value.
Cash value life insurance, 529, Atma. What else? 529, Atma, cash value life insurance. Yeah, that's it. Yeah. Yeah. Atma is capital gain tax at their bracket. Cash value life insurance, tax-free. Roth, tax-free, but after 59 and a half. 529, tax-free, only for education.
So that's the cash value.
Cash value is flexible. You can always give them their ownership after they're 18. You can wait until they get married, they have kids, when they're more financially savvy. Yeah. So it's case by case, you know, you have to see how financially responsible they are. All right, exciting stuff. Section 179. I love this. Thanks to our president, politics aside, these are the things that we didn't have prior to Trump administration. Who has a Range Rover or Mercedes G-Wagon or a huge car with 6,000 pounds or more? Okay. Who wants to have it? Nobody wants it? Okay. So, if you want to buy a car which is 6,000 pounds or more, 6,000 pounds, let's say G-Wagon, let's say Range Rover, let's say Mercedes GLS, right? Even if on December 31st, you make one payment, let's say you finance it, not a lease, one payment towards the financing on December 31st, and let's say the car's price is $110,000, you get to deduct the whole $110,000. That's crazy. That's crazy. That's why all the business owners, they all have G-Wagon. Not that G-Wagon is a cool car. I mean, it's just tax deductible.
What's the rationale?
Ask Trump. Boost the economy. That's the rationale. It was designed initially for construction companies and general contractors to boost the local production of the GMC and the American-made cars. But because they said 6,000 pounds, and we had a strong automobile producers lobbies, then the weightage became the criteria. So yes, please.
I have a question. How many times can you buy a car?
Every year I do that, and that's my excuse to my wife. Once a year. Once a year, yes, once a year. And you should not lease it. It should be purchased. It should be financed. Okay. Yes, please.
I asked my accountant about that, and said because we can't justify 100% that he didn't recommend that.
Yeah, accountants are conservative when it comes to that. Some accountants, they do that, some not. But I can tell you that it is. Because at the end of the day, it's the car that you go to work. You can justify that, hey, I'm taking some of the equipment, I'll purchase the equipment. Even if you get audited, as long as you say that this is my car, it's not my spouse's or my kid's car, and you prove that you are driving it, No, it's absolutely fine. I do that as well, and I don't need a car in my business, but I do that as well.
My accountant recommended leasing instead.
Ah, that's another thing. Lease means every month the monthly payment is tax deductible, right? And that's correct. That's a business expense. If you have a car which is under £6,000, that's right. But if it's over £6,000, even if you made one payment by financing it, you get to deduct the whole thing. So let's say you made $2,000 payment, is a $150,000 car. The entire $150,000 is deductible as long as it's over £6,000. So those of you who want to buy a car, just go on Google and search Section 179 qualified cars, or you just type over £6,000 cars.
So if you're deducting the entire thing, but you're financing the car, you're deducting 150,000. At the end of the year, you sell it and you bought a new one. Are you deducting another 150 every year, even though you've only paid like 12 payments?
Yep. 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 That's exactly what I've been doing for the past 2 years. I mean, I got one myself 2 years. Last year, I got the Range Rover for myself. December, I bought myself a GLS under the business, but I gave it to my wife. But on paper, I have to prove that the GLS is mine, although it's for her.
Oh, but you didn't sell the first.
No, I still have it outside.
But you could if you wanted.
I could. Yes, I could. Yeah.
Buy another one.
Yeah.
Does it matter who you sell it to?
No. No. To your wife, you mean?
I
Or?
was saying, what if like my brother-in-law wants to buy a G-Wagon?
Sure.
I say, hey, why don't I just buy for you?
Okay, if you get audited, can you prove that you are using it?
Oh, there you go.
Yeah. Right now, if I get audited, still is in our house, I'm showing that I'm using it as well, right? You have to be able to prove that you are working, you're going to office with the car.
Don't you think it was like you're pushing it was this deal? Because like you're not allowed to deduct if you're using it for commute. So the only thing you can justifying it if you're using it for business purposes, like driving from bank or post office,
Yeah.
or whatever it is. But then if you get audited, you also will be required to report the mileage.
That's for
using it, you need to keep a log. And
yeah.
It becomes way more.
That's for the business expense. Like in her case, when she's leasing the car, if the car is under, if you're under £6,000, then the expenses must be reported and justifiable. Then you are writing off the gas, the mileage, the wear and tear, right? The lease payment. This is only for Section 179. That includes the cars over £6,000, right? Okay, the car must be owned by the business. So when you go to the dealer, you need to make sure that the title on the DMV is the business. And if the business doesn't have enough credit, joint. You are co-signing with the business, right? Yes.
I tried a couple of times with 2 different dealerships.
Uh-huh.
They always ask me to buy that myself instead of my office.
Is there a credit issue?
No, nothing. They just said
Over £6,000 or under?
both. One's above, one's below.
No, I mean, just tell them that the moment that you go to any dealership, the moment that you say, I need something that is over £6,000, they get it. They know why. So you just need to make sure.
Also, they don't accept my corporate check.
Your what? Your corporate check?
I wanted to buy that for my office.
Uh-huh.
Those got denied. And the second was I had to use my personal check. I cannot use corporate check.
No.
No. Just a dealership.
Yeah. Which dealership was it? What car was that?
One was GLS and one was.
Not too sure about Acura, but what the first one was GLS, you said? Yeah. Mercedes? No. Literally like 2 months ago. 2 months ago I got it.
My car is my personal.
If it's over £6,000, it has to be under your business, right? So the title is your business, the payer is the business. That's very weird. It's the first time I'm hearing it. So I tell you, it's the person that you talk to. Yeah. Normal. It's basic. So if it's over £6,000, we are talking about Section 179, which is over £6,000. You need to just prove that you are working with this car, and you go to the office, you come back. You are the sole user of the car, right? If it's under 6,000 pounds, you need to keep track of the mileage, the gas, wear and tear, right? The lease payment. Those are very important, but that's for under 6,000. And then you get to deduct it on a monthly basis.
If you're doing this 179, can you also deduct your gas and your insurance?
I wouldn't do that. I wouldn't do it. If you ask your CPA, probably they will say, I will, depending who is your CPA, but I wouldn't double dip.
Does this apply to sole proprietors too, or are you talking just?
Yeah, sole prop. Yeah, sole prop. Doesn't matter.
If I
As
went out and just bought a car, it would be.
does your business have a bank account?
What?
Do you have a bank account for the business, for the sole prop? Yeah, that's fine. That's fine. Yeah, absolutely.
Is it, so if I'm updating my computers, is it too late?
Yeah, December 31st.
As
So
soon as December of this.
yes. So right now, for the equipment and the car, we can no longer deduct against 2025. So anything that you see here, any of these things that you buy, right, is all for 2026 onwards, right? Cars even. That's why all these dealerships, for car dealerships, November, December, they're booming because of the same reason. So yeah, that section 179 is amazing. It's just been around for past 2 years, so take the advantage of it while we have the man in the office. Correct. Goes to your business bank account. Correct. Most likely is lower price because cars are depreciating assets, not appreciating assets. Then you get to deduct that depreciation as well. Right.
So do you think the section 179 will be still applicable for 2026?
Oh yeah. As long as Trump is in the office, yes.
Oh.
Yeah. So take the advantage of it while he's around.
So, for the cars, what's the difference if you buy them cash or you have to finance it?
Very good question. That's more mathematical decision. Remember, so did you get the question? You mentioned what's the difference between financing versus buying. No difference in taxes, is a more mathematical, right? So if let's say you want to dump $100,000 to buy it in cash versus getting a loan at 6%, 6-7%. Yeah. No pressure, 6%. Versus you get a loan at 6%. Then my question to you would be, can this $100,000 grow somewhere better than 6%? Your business had 40% profit margin. Stock market maybe gives you 8, 9, 10%. You may buy that Airbnb by putting 100,000 down payment, get a $500,000 property, convert the garage, add an ADU, get an Airbnb income. So your cash may work smarter rather than saving the 6%. It's called arbitrage. So I would rather borrow at 5, 6% to grow at 8, 9, 10% so that I enjoy from that spread. So it's not a tax conversation, it's more a calculative conversation. Arbitrage. Yes, as long as it's under the business. Yes. So I'm sending clients your way. So you buy the equipment, 100% tax deductible. You get the loan, 100% interest is tax deductible. Thank you. So not only rate of return, but also tax deduction, 100%. Where else we can get that? Literally 100%. Whatever you buy from her gives you 100% tax write-off. And I'm sure that they can get 60-70% rate of return on the equipment. No pressure. Yeah. So take the advantage of this section 179 is amazing. That's why our economy is still surviving. Not that we are in a very stable global economy. Global economy is an absolute mess. But because of these incentives that we have, still market has not tanked. I love this thing, cost segregation. I'm dreaming about it every night. Yeah. I'm that weird dude. So how many of us know about cost segregation? How many of us own rental properties? Nice. How many of us own a building for our practice? Nice. Well done. So real estate, first of all, is a great asset class. If you are not into it, please get into it, as long as there is a balance, right? As long as you are not over leveraged, because real estate is about leverage and it's about arbitrage. It's a great asset class. But on top of that, again, thanks to Trump, we have this cost segregation, which means, you remember when you were filing depreciation every year on your property? Now you can squish it. Instead of doing it for 30 years, you can squish it in 1 year or 2 years or 5 years. It's called accelerated depreciation. I'll give you an example. You buy a condo in East Bay for $1 million. Over 30 years, you get to depreciate it, right? Because it has a depreciation component into it. You get to depreciate about $3,000 a year, right? Depending on your property, depending on the land price, depending on how aggressive is your CPA. But because of cost segregation, you just bought a property in Dublin, let's say, you get to depreciate the whole thing that you had to wait for 30 years. You get to depreciate the whole thing. And you get to write off about $350,000, which will save you about $150,000 in taxes, right? That's called cost segregation or accelerated depreciation. And guess what? Great news. You can still do this and deduct it against 2025 taxes.
Is this like your business has to buy these properties?
Your business can also buy the property. So let's say it's the condo that you're running your office in, or is a rental property. But there's a catch here. Either you or your spouse must be able to prove that you're either working 100 hours a year on managing the property, as long as it's a short-term rental, or 700 hours a year if it's a long-term rental. So let me repeat again. It's either your property that you're working there, is your practice property,
Yeah,
then it's fine, because you're working there, right? You don't need to prove anything. It's your business. If it's a rental property, we have two categories. Short-term tenants, long-term tenants. Let's say you Airbnb the thing, renting it to traveling nurses. Perfect. You have to prove that you have worked 100 hours a year on managing it. Either you or your spouse, doesn't matter. If it's a long-term tenant, more than 3 months, then you have to prove that you have worked 700 hours a year on managing it. Chasing the plumber, chasing the whatever, the wear and tears of the house, the property manager, all those, right?
So the building depreciation, is that in correlation to the loans?
No. The building can be paid off or has a loan. Doesn't matter. So there are three types of buildings that we have. We have a building that we have our practice in it. Every year we are taking the depreciation, or if we have a very good year, we need more tax deduction, we can then squish it. It's called accelerated depreciation or cost segregation, right? Or if it's a rental, depending is it short-term or long-term. If it's short-term, you have to prove it's 100 hours a year management. If it's long-term, it's 700 hours a year management.
Yes, so I have a house that I still not sure if to sell or rent. So for the repair whatsoever, can I claim that as a rental expense?
You have a house that is rented already?
No, I either want to sell or to rent. I'm not deciding yet.
Oh, but that's not your primary.
No.
So it's just a house vacant, sitting somewhere. Okay? And you don't know whether you should sell it or rent it.
Most likely my wife wants to rent it.
Okay, can I know roughly the value or mortgage balance?
That mortgage is about 500.
How much is the value roughly?
Right now it's about 3.5.
3.5, and then 500 is the mortgage. So basically we have $3 million equity here. And if you rent it, how much cash flow you get? 10,000 a month, but still we are negative.
No, the
Break even-ish?
about 3,000.
Oh, 3,000 a month is a mortgage? Oh, wow. Your interest rate is so low.
Yeah, it was like a two something.
Jeez, that house is gold. Never sell it.
My wife, yes, she want to keep it.
Please keep it. Does that house cost you more than 30,000 every 2 or 3 years to maintain it for damage control?
Praise the Lord.
Okay, that house is amazing. Just keep it, please. Don't sell it.
Can I claim the repair whatsoever as a rental expense?
Yes, those are
Even if
expenses.
I haven't rented yet.
It's fine. It's fine. It's fine. It's not your primary residence. It's investment property.
Oh, okay.
Yeah. You're not living there, right? Your wife is not living there, right? Okay. Right. Fine.
How does that affect the ADUs? You know, where you have someone as a primary, that's your primary home, and then you have an ADU being rented out. How does that?
The ADU has the same tax that your property has. The only thing that you can do on your ADU is depreciation. As long as you show that you work 100 hours a year. If it's short term or long, is it short term or long term? Okay, if you want to build an ADU, if you have an ADU and if you want to Airbnb the thing, then it's short term. You have to prove that you work 100 hours a year to manage it, then you can write it off.
I guess it's this option. If you already have like an real estate and you can potentially do an Airbnb, you have to actually file with the county. Is that how it works?
Yes, and where is in the Bay here? Yeah.
So that's the first question. Can you tell me distinguish investment property versus like a second home that you don't live in? So how do you?
Depends which one. Depends whether you want to report it as investment property or as your second home. Each of them has got its own pros and cons. If it's your second home and at some point you want to sell it, as long as you say over the past 5 years, 2 years of it I lived there, then you can sell it with $500,000 capital gain tax exclusion. 2 out of 5 years you must have lived there. So the question here is, what's the purpose of that house? Are you going to sell it, rent it?
It's just like somewhere that you go visit. Like let's say you have a place up in Tahoe.
Got it. Got it.
1 month a year.
What are the chances that you will sell that in the next 10 years? Okay, so are you going to Airbnb it or is it just for personal use? Investment versus second home, and you're not going to sell it. Let me tell you what are the differences. If it's considered as investment property, you get to do the cost segregation that we are talking about. Accelerated depreciation, right? If it's a second home, then you can't. But if you sell it, the first $500,000 capital gain that you have will be waived. Oh, you're single or you're married?
No, I'm not single. I have another question. I thought you can only sell in California one time and get the tax benefit. Can you do that for multiple homes?
Is your second home, right? Yep. Now, when you did the loan, how did you report it on your mortgage? Okay, then fine. Yes. Yeah. If you sell it, the first $500,000.
The question about like if you're buying it under your personal and renters that are suing you, do you need to have like a separate? Would it be beneficial to have a separate company, rental management company, buy your property?
Okay.
So to protect the renters.
So the question is, if we have a rental property and if you're worried about litigation, if they sue us, what should be the entity? First of all, when you read the land law, the very first thing that says on the book says there is no such a thing as asset protection in the US, right? So at the end of the day, there's no way that we can hide it. The only way that you can protect the asset is to disown it, gift it to somebody else, which you will lose control, right? So, but if you want to have the basic level of asset protection to protect yourself against bankruptcy, against litigation, right? You have to have an LLC, right? Put the property in the LLC, and then that LLC is under your trust, so that not only you're protected against probate court, but also against the litigation, right? Now, on top of that, you have to call your insurance agent, the PNC insurance agent, the person who insured your car, and get yourself commercial umbrella insurance on top of the LLC. So if your tenant files a lawsuit, they don't have access to your practice immediately. They don't have access to your primary residence and your cash in bank immediately. If they subpoena, it takes them 3 to 5 years. They will have access, but you buy some time for yourself. But you also have the umbrella insurance. For every $1 million, you have to pay $30 or so per month for umbrella insurance. Umbrella insurance doesn't protect you. It pays for the law firm, right? So it actually hires an attorney for you and pays for the legal fees and judgment.
And you can get that insurance without.
Yep. It's a personal umbrella.
So one more question. So when you have the LLC, so a lot of times, like let's say you started buying a home before you knew all these things, and you bought a house under your own name, and now the loan is under your name, and now you understand that you don't
Yeah.
want to have everything under your name.
Yeah.
You want to have a bunch of different LLCs, but now the loan process, the loan
Yeah.
is not under your name.
Yep.
Is there a back way of going around
Yep.
that and not have to go to every financial place and
Yeah.
say, hey, now I'm doing that? Because I'm running into a lot of issues, especially for my own dental practice,
Yeah.
where the loan is under my name, and now they won't approve me, or I have to start again, and I don't want to be doing that. So
Exactly.
how do you go about putting that under a
There-
different LLC?
Exactly. There is a clause that says do on sell clause. Whenever you want to transfer the ownership from an individual or trust to an LLC, the do on sell clause will trigger. As long as you have a note on it, as long as you have a mortgage, it will trigger. First thing that you have to do is to call to your lender and say, hey, Mr. Lender, hey, Mrs. Lender, I'm the same person. For asset protection, same estate ID, I need to transfer the ownership for asset protection to my LLC ahead of time to avoid the do on sell clause issue. I can say 70% of lenders are paying, they don't accept it. So you need to really have a buddy in the lending industry to do that. No pressure.
No pressure.
Can we do on sell clause? Can we bypass that with PNC?
I have to check on that.
Yeah. It is possible. I can say 70% are paying, 30%, 30% are good. They do that. Is not illegal. It's possible. Best thing is to let them know in advance and then use a mortgage broker or a lender from an institution that you're a friend with to do that. You just need to have a conversation in writing to tell them why you're doing this. Because their main concern is you're walking away from the note. That's their main worry. That's their main worry, right? But even if they don't do it, it's not the end of the world. In a perfect world, you should have a trust, revocable living trust, that owns your primary residence, owns your S Corp, your practice, owns all your rentals, and equivalent to your net worth, you should have umbrella insurance. Because if I'm going to sue you, I look into your net worth and then sue you based on your net worth. So if your net worth is $6 million, get $6 million umbrella insurance. Right? That's the basic that you should have. Don't let that do on sell clause stop you. As a backup plan, just put everything under the trust to protect you against probate court, and then get yourself umbrella insurance. So at least if you get sued, the umbrella will kick in. Especially for those of you who have teenagers at home. A 6-year-old, 16-year-old, 17-year-old at home who just started driving. Let's say you bought them a Honda, $20,000, and then they're drinking and having fun and all that. We all did that, right? And suddenly they hit a car, a Ferrari, that is driven by a plastic surgeon who makes $2 million a year. Then we have a problem because your child's car insurance covers only equivalent to a Honda, not a $500,000 Ferrari that has been driven by a plastic surgeon who makes $2 million a year. And the plastic surgeon's attorney is coming after your child and your estate. That's where umbrella insurance is needed.
So I thought you said it's only, you will only cover for the legal fees.
And litigation. Yeah, judgment fee and legal fees, the attorney fee, and of course the settlement.
It includes the settlement.
That's why you have to have it equivalent to your net worth, because that's the number they go after.
So I tried to get umbrella policy, and they told me that my daughter had to have
How old is she?
she's 17.
Okay.
For 2 more years before they would insure the car. All around.
Yeah, exactly. Exactly. Please make sure you all have umbrella insurance. It's really important. It's very cheap. You know, $30 per $1 million.
So that would be for the homeowner insurance,
Yeah.
umbrella, and then separate for
It's
the
a personal insurance. So, yeah, so exactly. If you have an LLC, that LLC will have commercial umbrella. If you don't have LLC, it's just personal umbrella.
So the LLC could buy umbrella.
Yep. The umbrella is for the LLC. It's commercial umbrella. A little bit more expensive, but still worth it. So everybody in this room must have a trust. Everybody must have equivalent to your net worth in umbrella insurance. Life insurance also very important. Very important. Long-term care is very important. So yeah, you never know. All right, QBI deduction, section 199A. Remember we were talking, I think, earlier about how much of expenses we can report? At least you're reporting 20% of your revenues as expenses, right? So any equipment that you buy tonight is tax deductible, right? If you end up buying a commercial building, the interest is tax deductible, and that building is depreciating assets, so you can cost segregate it. So this is basically repeating that any qualified business deduction is tax deductible as long as you bought it before December 31st, right? So that's why sometimes you can just November, December, just go shopping, even if you don't need it.
Is there a maximum amount for that?
If you are making $1 million, you cannot show more than $800,000. Yeah, especially if you are in a maturity level of your business, year 4, 5, 6, right? Yes, it's red flag. Yeah, prepay business expenses again before December 31st. Your lab fees, your supplies, your insurance, your rent, all of those things. That's why I said by November, December, just go shopping. Buy a car. Any guys with car, any enthusiast car guys here?
Only you.
No, only me? Okay. My wife says the same. You are? Yeah.
You recommend either buy a used car if you are going to get one, but don't buy a brand new one?
Oh, okay. Brand new versus used car. I mean, if it's 6,000 pounds, doesn't matter under section 179, double bonus. Doesn't matter whether it's brand new or used. Used car is already depreciated, right? So mathematically, it's better to buy a used car if you don't mind. Lease, if it's under 6,000 pounds, and if you are really not driving more than 11, 12,000 miles a year, actually sometimes it's better because cars are depreciating assets, lease payment is lower, you can reinvest your money somewhere that grows better. Yeah. And all right, this one, again, I love this part. How many of us have highly concentrated stocks that you're worried? Let's say you say, I have a lot of NVIDIA stock, a lot of Amazon stock, a lot of Meta stock that I want to diversify to de-risk, right? But I don't want to pay a lot of capital gain taxes. There's a solution for it. Charitable remainder trust. For anybody here who has either a highly appreciated stock or real estate, or wants to sell the business, at some point you may say that I want to sell my business, but you do not want to pay capital gain taxes. This is the right solution for you. Charitable remainder trust. So, I give you an example. Last year, one of our largest cases was a hotel owner who sold his hotel in Natoma, Sacramento for $50 million. He had to pay about $19 million in taxes. But through the charitable remainder trust, he didn't pay anything. $19 million was saved. For practice owners, if at some point you want to retire, you want to quit, you want to stop, you want to exit, you want to sell the business for, let's say, $1 million, $2 million, you don't want to pay taxes, that's a possible option depending on your overall goals. Or if you have a lot of highly concentrated stock, you want to de-risk, you want to diversify, you don't want to pay capital gain taxes. Again, this is a suitable strategy. What is that? What is that? It's a legal document. It's called trust. An attorney takes about 3 to 7 working days to create that. It costs about $3,500 to create that trust. And then, once you have that trust, you can have a bank account for it, right? It's a CRT trust, charitable remainder trust. You can have a bank account for it. You can have a brokerage account for it. Let's say you go to Charles Schwab, open up a brokerage account which is owned by the trust, by the CRT, right? So first you need to create it and open up the bank account or the brokerage account. And then sell that highly concentrated stock under the name of the trust. Not you. The trust is going to sell it. So the proceeds goes to the trust bank account. Okay? Not to your bank account. No. Doesn't matter. It's your stock, it's your property, it's your business. The only thing that you need to be careful, if the money has already gone to the escrow, if you have already sold it, it's too late. Before the money goes to escrow, before you click on sell, you must have the trust. It takes about a week, 3 to 7 working days to create that trust. Costs you $3,500. Then the trust is going to own the bank account. Then the trust will sell that stock or that business or that building. And then the money goes to the trust bank account. Okay? Without paying any taxes. Now the bank account has $1 million into it, $2 million, whatever it is, right? Now, we can now grow it, right? Mutual funds, index funds, ETFs, whatever you want, right? We can now grow it. Tax deferred. We can start taking income out of it. 5, 6, 7, 8, 9, 10% a year, depending on how much the money is growing, right? Now, depending on your age, you can take about 7 to 10% a year out of that money every year for the rest of your life. When you and your spouse pass away, God forbid, the remainder, whatever is left in the trust, goes to a charity. That charity can be a random 501c3, let's say Stanford Cancer Research, church, synagogue, anywhere. Or it can be your family foundation. So the money comes back to your family. And then we put kids on the family foundation as the executives. So the money stays in the family. Now you know why all the politicians and Hollywood people, they all have a charity. Not that because they're good people. Because they don't want to pay taxes.
But this can't be 401k.
No, that's pre-tax money. Very good question. That's pre-tax money and we have to pay it. The 401k, no, you should not actually. You should not. You should not even put your 401k in the revocable limit trust. Because the trust tax bracket is 2% higher than your 401k bracket. So if you have a 401k or IRA, just make sure your spouse and then your kids are directly the beneficiaries. Don't put the trust, because trust has about 2% higher tax bracket.
But what numbers are you looking at?
Minimum $500,000 gains. Minimum $500,000 gains. If it's less than that, it really doesn't make sense.
So this is for like the stocks, a business? Or
Yeah,
not a
stock,
personal property, right?
stock, business, or any real estate that you do not want to, let me bring the calculator, that you do not want to do 1031. Because with real estate, you can do 1031 as well, right? 1031 means, let's say you have a $2 million property, you sell it, within 180 days, get another $2 million or more. You're deferring it. You're not paying any taxes, right? And then after you pass away, it goes tax-free to your kids. That's 1031. But let's say somebody says, no, I don't have kids. My kids are into something else. They're not interested in my estate. I just want to exit. Then the CRT makes sense. I'll give you an example. This calculator is very easy. Literally, American Heart Planning giving. It's for American Heart Planning. Just Google Charitable Remainder Trust. Let's say somebody wants to sell the practice for $2 million. No, 1 million. Which one is more realistic? 1 million or 2 million? 1 million? 1 million. And do we know how much is the cost basis of that? 1 million? Let's say it was from zero. If we sell a practice that the cost basis is zero, let's say, that means we have to pay, let's say if you're married and you're making almost 7-figure income, let's say 800 a year, you have to pay about $360,000 capital gain taxes, right? But let's say you say, I don't want to pay that. Why should I pay that? Then you say, okay, I'm going to pay the attorney $3,500. I create the charitable remainder trust. Let's say you are 70-year-old. Let's say your spouse is also 70-year-old at the time that you want to sell. So what happened? You sold the practice at $1 million inside the CRT, inside the charitable remainder trust. The trust will give you and your spouse 7% for the rest of your life and your spouse's life, 70 grand a year, lifetime pension. You live until age 120, it will pay. Right? 70,000 a year, joint income. And then the moment that you both pass, the remainder, whatever is left, goes to a charity of your choice or to your family foundation so that your kids will take over. Also, right off the bat, you get almost $300,000 charitable deduction, which you get to use it to offset your tax liability. Right? You can spread it over 5 years. So I repeat, you want to sell your business. You're 70-year-old, your spouse is 70-year-old. You want to sell it for $1 million. You don't want to pay $360,000 capital gain. You pay $3,500 to the attorney, sell it inside the trust. The trust will give you 70 grand a year for the rest of your life and your spouse's life. You don't pay any capital gain tax. Also, you get $300,000 charitable deduction, which you can use it to offset other tax liabilities. Maybe you want to do Roth conversion. Maybe you had a lot of defined benefit and cash balance plan that you want to convert them to Roth. That's taxable. Use this $300,000 to offset it. Maybe you want to sell some stocks. You don't want to pay capital gain taxes. Use that $300,000 to offset it. And then when you pass, when your spouse passes, then the remainder goes to a charity.
Is it easy to set up a family charity?
Yeah, about $7,500 cost. Yeah.
So you just talk to
Yeah. Family foundation. Yeah. $7,500. If you do both together, is about $7,000. $3,500 CRT and family foundation $7,500 instead of paying $10,000, $11,000 together about $7,000. Depends who you hire. I'm just giving you our rates. Your share.
So it's not an S corp or LLC. I donate my shares to that trust.
Absolutely, your share.
And then when you sell, then just my shares convert.
Exactly. Just like imagine you're selling your Google shares. In the trust, we have to say, what are those shares? Same thing with your business. Who owns it and what percentage? It has to be written in the trust, and then the trust will sell that share. And then your partner can sell it however they want it, whenever they want.
Where's the 7% coming from?
Based on your age. If you're in your 40s, about 4%. 50s, about 5%, based on life expectancy. Your 80s, 8%, yes.
And so I can put my S corp into this.
Tell me more. Why?
Oh, okay. So for the charity CRT, so can I put my S corp ownership into the CRT?
And then sell it?
What in the future?
Not now. Don't do it now because you lose control. When you want to sell, let's say you say, I want to sell it in June. Okay, we need to start planning now, right? If you sold already, it's too late. So the same year that you want to sell, right? The year is very important because if you're selling in 2026, the trust must have been created in 2026 and the gift giving must happen in 2026. You cannot create the trust and then sell in 2027, right? So we need to make sure both happen the same tax year, the same tax before December 31st. Okay, same year.
So we can set up this charitable remainder trust whenever we want. Like just say I die and my wife needs to liquidate the practice. It's good to have this set up ahead of time so she can just sell it through this, right?
No. What's the rush? No. She can.
What if I die now? Like, what if I'm worried I might die?
Okay.
And so this way she doesn't have to think about it. Like, am I able to just?
No.
Is it a good idea to set these up now?
No. Honestly, all you have to do at this phase, ask yourself, God forbid, you die tomorrow. Can she manage the business?
Given 1 year, right?
No. Is she a dentist too?
No.
Okay. So what would happen if you die? What's the plan?
I am in a disability group. They would keep running the practice for a while.
I would start working for
Yeah, and then I think we just have to run it until my wife can start.
Okay.
Given a year.
Yeah. So the only thing that you need to do, make sure everything that you own is in your revocable living trust, non-negotiable. Okay. That practice, your house, everything in the trust. That's number one, right? So God forbid you pass away, she has full power of attorney to do anything she wants, right? The way that you designed the trust, right? That's the first thing. Second thing, ask your wife, if I die tomorrow, ask your wife, if I die tomorrow, how much per month do you need to maintain the lifestyle? What is her answer, do you think?
Much as I can get. Liz will be like Sean.
15,000 a month, 20,000 a month?
Yeah, probably. That would be pretty good.
So if she says 20,000 a month for the rest of my life, inflation adjusted, open up the calculator, 20,000 times 12 divided by 5%. You must have $4.8 million in your estate, either insurance or non-retirement assets, so that when you die, this $4.8 million, your wife can go and put a couple of rental properties and maintain that $20,000 a month through the trust, right? So that's so two things you need to only think about: trust and liquidity to maintain that income. And then later on, through the trust, she can sell it, because through the trust is cost basis, step up in basis. Let's say your cost basis is whatever today, 0, and the practice is $1 million. You die tomorrow, God forbid, the cost basis will reset. She's responsible for the gains from the day that you died.
Okay. Oh, so she won't have to pay taxes.
Step up in basis. That's why it's a trust.
Oh, okay. That's good.
If he needs $20,000 for 12 months, why is it 4.8?
So $20,000 a month.
Yeah.
If you have $4.8 million check right now, and you buy a couple of rental properties that they give you 5% cash on cash, $20,000 a month for the rest of your life without dipping into the principal, right? So Ask yourself, how much my surviving spouse needs per month? That number times 12 divided by 5%, 4.8.
Are you saying I should have that much life insurance on myself,
Or
have the money?
Thank you. Or the money, or something that is not retirement, because you're very young, your retirement assets are not touchable right now. So some 4.8 is needed. If you have it, perfect. If you don't, you need to address the balance with life insurance for the next 20 years, because in 20 years time, you already have enough. Your kids are independent. Your mortgage is almost paid off. It's just the next 20 years that you need this.
So you said the trust is set up the same year as sale.
The CRT trust.
Right. So basically, every time you do something, you need to set up a new trust.
So depends how you want to invest. If it's the same investment strategy, not anymore. Let's say you want to sell $1 million Google stock, goes into the CRT, and be invested in S&P 500 grows perfect. In 5 years' time, you want to sell the practice, another $1 million. As long as it's the same investment strategy, goes again to the same account. So you don't need additional trust.
So the source of money doesn't matter. It's what it is invested.
How we invest it matters, exactly.
This is kind of a tangent, but I forgot what it's called. But say if I have a lot of one stock that went up a lot, and I want to like lower my risk profile and diversify it. There's some sort of exchange or something that
Thank you. Exchange funds. Let's say you have a lot of NVIDIA. You want to diversify, right? You don't want to sell it because you have to pay a lot of capital gain taxes, but you can go to the exchange fund, which means without selling, you go and invest in S&P 500.
Yeah.
You're not putting the money in your pocket, you're just exchanging. Yeah. It's tax deferred. Whatever gain that you have, you roll it over into the new thing. And the new thing is growing and deferring. But the moment that you sell, you have to pay not only gains of this guy, but also the original one.
So is it better to buy something that just pays a dividend so I don't have to sell it?
No, you're very young. I mean, you're 40. Okay, what's the secret? You look so young. So, right now, you're young. Dividend is for 70s, 80s, right? For now, your goal is growth. As long as you don't need the money for the next 5 to 10 years, right? Just grow. S&P 500, double it every 7 years.
What's the name of that exchange? Is there a number for it?
No, depending who you do business with. I mean, exchange fund. It's just tax deferred exchange fund.
I would just call the brokerage and say.
Yeah, you just need to find somebody like me, basically. Yeah, somebody who has Series 7. They can do that. Yeah. I hope it was not overwhelming. So the moral of a story, you're going to buy a car, sir, right? Over 6,000 pounds. Yes, please.
So if my accountant is worried about doing that, what?
Yes, some accountants are really old school. Really old school, very conservative. Nothing wrong with that, but you have to shop around. Right?
Nothing I can say to him that's like, hey, go back.
I mean, if they were into this, then they would have recommended it to you, right? You know, one of the reasons that people like us exist is because an accountant is responsible to just file. People like us are responsible to integrate financial services into accountants' existing practice. That's why we are offering CPEs to accountants. We teach at Cal CPA. We give them 4 hours credits. Their CPE is continuous education, right? Just because they need to get this updated thing. It's the same thing like your field. You can't be expert in everything about it, right? Same thing. Accountants, they don't do financial services. So shop around. Always shop around.
But if I get the car though, car repairs and everything also deductible because you said
7,000 or 6,000 pounds or less. Repair, yes. Mileage and gas, please don't do it because it's double dip. Although a lot of people do it, I personally don't do it. I professionally don't recommend it. It's double dip, but many people do it. But if you get audited, that doesn't work. All right. Thank you so much for bearing with me. Any? Thank you. Any questions, please feel free to reach out. That's my phone number, my email.